Good afternoon, ladies and gentlemen. Welcome to this webinar organized by the Belgian Financial Forum. I'm Freddy van der Spiegel, professor at the VUB, and I will give a brief introduction to the seminar, for which we also have three excellent speakers from academic and practice. So, the purpose of my brief introduction is just to give a situation of what is happening with monetary policy, what has happened certainly for the ECB since all these crises started, and how the situation today is totally different from the situation that was conceived when the euro, the eurozone, and the single currency started end of the last century. And this means that there are challenging times for the ECB that has to make decisions which are not easy. And it's totally different from the concept of monetary policy at the start. At the start, it was relatively simple. The euro system, which means the balance sheet of the ECB together with all the balance sheets of the central banks of the member states participating in the euro system, was about less than 1,000 billion, which means in comparison to other commercial banks, an average sized bank. And the interest rate was all the time between 2 and 4%, was never surprising. The goal for the ECB was, according to all the political accords and treaties, to keep inflation under control, which means concretely, well, if inflation goes above 2%, the ECB has to react so that the inflation is remaining close to but below 2%. Inflation was the core purpose, the core parameter for the ECB to take decisions. There was a secondary goal, but that was only a goal if inflation was under control. At that time, when inflation was under control, the ECB should stimulate growth of GDP. That means bring the interest rate as low as possible without creating inflation. This was a simple system. Getting to an agreement at the EU level was not simple because some member state has had another tradition of monetary policy than, for example, Germany, that was very strict on inflation. But the consensus was this model, which is still the fundamental model today. But in reality, the situation changed. And the situation changed because we got, since 2008, a series of crises and disruptions, starting with the banking crisis, financial crisis. By 2010, 2011, we get in Europe the sovereign crisis, which becomes then a euro crisis, where then at that time the governor, Mr. Draghi, had to convince the public that he would do anything that was necessary to keep the euro secure. And then afterwards we got the pandemic, and now we are in the Ukrainian crisis. This is a series of crises that each time is has an impact on financial systems, on the economy, and on government budgets. And today, the ECB has reacted. There was no alternative, but the balance sheet today is 8.5 trillion. By far, the ECB is the most important bank, if I may consider it a bank, in Europe. On top of that, the interest rate since years now is negative, the official interest rate, in practice very often negative. So close to zero, but negative. And we have a continuously growing balance sheet with very low interest rates. Now, this model, or the practice, the reality, is now challenging the model of the theoretical model of the ECB. suddenly about 1 year ago, because of some of these crises and their effects on supply chains, suddenly we got galloping inflation, which today is 7 to 8%. Other speakers will go more into the detail about that. And now the question for the ECB is what to do. In principle, theoretically, it's simple. Inflation is higher than 2, so the ECB has to react. But there are a number of buts that make this decision more difficult. First one is the GDP growth, certainly now again with the Ukrainian crisis going on, is already rather low. Some already talking about recession, and should and can now in this circumstance, while you have inflation and low growth, a kind of stagflation perhaps, should it be possible for the ECB to increase interest rates, which will again be negative on economic growth? In theory, nothing has changed for the ECB. ECB should look at inflation. Practically, it's a totally different situation. On top of that, we have had experience with the euro crisis and some member states a couple of years ago that were in trouble. But today, more than ever, the question is, can we keep the club of the eurozone countries together? Because if interest rates go up, financing the already high debt of some member states will become extremely difficult, which could create a new sovereign crisis. And on top of that, with a total balance sheet of 8.5 trillion, it is clear that the ECB is not just a marginal financial player in the markets, but is a major player. And if the ECB takes decision about reducing the balance sheet, which means selling lots of assets, that again could create disruptions in the financial system, panic in the markets. And then the question is again, what will happen then with certain banks that are not completely resilient for new shocks after the banking crisis of 2008. And all this together is extremely complicated because all these different elements are interacting and are conflicting. It's easy to keep inflation under control, but then you will create a recession and you could create political problems in the Eurozone and you could create a new banking crisis. And at the same time, the ECB is now the supervisor of the banks. So it would mean that the monetary policy is conflicting with the mission of the ECB as a supervisor, macroprudential supervisor. So this is the reason why the debate about what to do is very interesting, but also very difficult, also because not all member states in the Eurozone have the same vision. The north of Europe is different from the south of Europe from a perception of what should we do. And therefore, I'm so happy that we have our three speakers that all are going now into the details of where are we, why are we where we are, what could happen, and what should the ECB do. And the first speaker there is Gert Peersman, professor at the University of Ghent. Gert, the floor is yours.
Okay, thank you, Freddy. Thank you very much for the invitation. Since I have only 20 minutes, I will limit my presentation to the question whether there is a comeback of inflation, whether we are in a new area of high inflation that might last for a while, and whether we should expect higher interest rates in the near future, and what about interest rates at a more longer horizon. Now, in order to address that question, let's first have a quick look at what is exactly the inflation target of the ECB in order to know how is the ECB going to react to potential inflation and what might still be in the pipeline. Well, maybe some of you do not know and still think in terms of the below but close to 2% inflation objective. Well, the ECB recently in its strategic review has changed its inflation objective slightly towards 2%, not below but close, but exactly 2%. This target is now symmetric, which means that positive and negative deviations are considered as equally bad and should be avoided equally. And what is important here for my talk is that they say it has to be over the medium term. Yeah, over the medium term. Why? How do they motivate that? Well, in a sense, you can motivate it first because there are lags in the transmission of monetary policy towards the economy and towards inflation. Now, it comes to that, for instance, when the ECB changed its interest rate, you see a lagged impact on inflation, which is typically only 1 year or even 2 years after the monetary policy intervention. So that implies, on the one hand, that it doesn't make any sense to react to shocks that are only temporary. Assume, and typically ECB considers oil price shocks or food commodity shocks, that these shocks, these shift prices, but when you react to it, it takes about 2 years, then the shock is gone again. So there's no point of doing that because that's not very good for the economy. Moreover, on the other hand, the medium-term horizon also gives the flexibility to assess the source of the shocks and look through, have a look at, okay, should we react to the shock or not, depending on what is the underlying shock and underlying driver of inflation. And to be more specific about that, there is a literature called optimal monetary policy. And in a nutshell, the conclusion, and that motivates a bit the medium term of the ECB, is that when the source of inflation is domestic or demand driven, for instance, because there is an overheating of the economy, because labor markets are tight, which are rising wages, overheating of the economy is increasing profit margins of firms and so on, well, then the message is very clear. Demand shock, interest rates should increase, it should reduce aggregate demand because of the policy tightening, there will be less demand, the overheating should vanish then, labor markets become less tight, and therefore you bring inflation, let's say, back to the target. And that's clearly the case today in the United States, where we see both tight labor markets, rising wages, and rising profit margins of firms, and there the Fed clearly already has decided, let's increase interest rates. Now the situation is different, and this is more popular narrative for the euro area, when the source of inflation is imported. Yeah, so if it's imported inflation, and then you can think in terms of energy, like gas prices going up and oil prices, food commodities, industrial commodities. If you import these commodities, of course, they also increase prices. They will be passed on to inflation, to consumer prices, and then you have higher inflation. Well, here, optimal policy is actually that central banks should not react to that. And they should, in fact, just tolerate what we call the one-time price increase because of higher energy and food commodity prices. Well, why? Well, in Dutch, we have this expression, wanneer je geschoren wordt, moet je stilzitten. Yeah, so what does it mean? Actually, is if we have imported inflation, you better do not react to that as a central bank, because the monetary policy tightening first will not solve the problem. Yeah, it's not possible to take away these rising international prices, which are just on international markets. That's not within the euro area. So for the ECB, you might hardly have any impact on these international commodity prices. And second, when you start to react to that, you're actually deteriorating your internal economy, you're reducing economic growth, economic activity, you're increasing unemployment. And that, of course, has a downward impact on inflation, but at the same time, this is clearly different from an overheating economy. At the same time, it's really destroying your economy. So then it's not a good idea. And that's a bit, as I said, the popular narrative for the euro area. And if you take this together and you look at these objectives of the ECB, and you take into account that you better do not react to temporary shocks, typically oil prices, to imported shocks, again, energy prices and so on, Then one can wonder what's the problem. Yeah, so what is the problem? If you look at this, at core inflation, which is excluding the very volatile oil, energy and food commodity, raw food commodity prices. Well, if you see here, you have the projection of the Euro system of core inflation. Then core inflation indeed will in 2022, according to the projections, increase above 2.5%, which is clearly above the target. However, in 2023 and 24, you see that inflation will return below the target of 2%. So very simply, one could argue there is no reason to react for the ECB. There is no problem. There is no inflationary problem. However, I'm not convinced about that. I think that view is a bit too optimistic because there might have been what I call a regime shift in terms of inflation dynamics. And especially if you look at all these projections, so the dotted line is the projection up until today, the most recent forecast of the ECB, while all these other black dotted lines are the past forecasts. Yeah, so these were always the past forecast at each point in time over the past, as well since 2010. And as you could see, during the 10 years between 2010 and 2020, the ECB was actually systematically overestimating, overprojecting the inflationary pressures and the increase of core inflation. They always expected core inflation to go up. Well, in the end, what happens? Core inflation did not move up. Clearly, there was something wrong in the forecast. They were like biased and distorted. The forecast errors always went in the same direction. Well, what one can see since COVID, since 2020, we see that it's the other way around. So typically the ECB always is actually underestimating the impact. And here I'm not taking into account the energy price and food price. We're talking about core inflation. Is systematically underestimating the true inflation rate. And I'm a bit afraid and worried that this is also the case today. And it might not be that inflation will return to the target relatively soon, and we might be in a period of let's say, where inflation lasts for several years. And why? Well, there are actually three reasons to motivate this and to have a look at that. And the first reason is that, and I think that in the end I will conclude that the ECB should indeed raise interest rates. And first, it appears that the source of euro area inflation has become a domestic phenomenon. It's not just imported inflation anymore. So you see import deflator, which is the right panel in all these countries, that clearly was up. Everybody agrees about that. But the best way to look at it, to the fact whether inflation is now also domestically present, is to have a look at the GDP deflator. Why? Well, not many people look at GDP deflators to measure inflation. First, because it's only available with a lag, and second, the data are quarterly. But they are very informative about this question. Is it imported inflation, commodity prices that are increasing and that are passed on to consumer prices, imported commodity, or energy and food and so on, versus is it purely domestic? Well, the GDP deflator is the price of the domestic value added. So that's in a sense the combination of rising wages and rising profit margins of firms. And also consumer taxes are included in that and affect the GDP deflator. Well, as you could see, in the US, we all know the story. The GDP deflator is moving up. That's the black line, and that's a domestic source of inflation. Well, actually, also over the past year, we see the same story in the euro area, perhaps to a bit lesser extent, with the exception of Belgium. We are even having more GDP deflator inflation compared to the United States. But you clearly see that everywhere prices domestically are moving up in the euro area. France is the only exception, but that's a bit artificial because they keep artificially their energy prices low. So they're actually decreasing the profit margins of energy companies. And as such, for the time being, the deflator is there lower, the rising deflator compared to other countries. But as you could see in Germany, even Germany, Belgium, and the euro area more generally, we see that, well, inflation is also domestically present. And in fact, the main reason why the GDP deflator is moving up here, it's profit margins of firms. So firms are increasing their margins, and that increases also prices. In Belgium, it's a combination of profit margins and also wages that go up. In other countries, it's not yet wages, but that's only a matter of time. It's only a matter of time, because when you look at labor markets, you see that these labor markets are very tight. And perhaps unions and other countries, they will start asking higher wages. This will translate into higher wages, especially if you know that also prices are rising, and of course employees want to be compensated for that. And you see, for instance, that the unemployment rate is currently at a historical low level in the euro area. And if you look at shortage of labor and the way that this affects production of firms, you see that this is at highest level over the past 20 years. So also there you see a lot of domestic pressure. And why is that? Why start wages to increase and labor markets are tight, and why profit margins are increasing? Well, in general, the business cycle, it's a bit surprising if you say that today, but the business cycle, the recovery from COVID is going really strong. It's going really strong. And this you can see in this picture here. This is the output gap in the euro area. So the output gap, the black line, that's what is called potential output. That's the output level when the economy is essentially at its full capacity, more or less at full capacity, when labor markets, unemployment is, let's say, low, where you do not have, you can't go above that. That's when there are a lot of vacancies in your economy, and when firms are really at full capacity and going over full capacity, and so on. So then you have a positive output gap. But as you could see, that now we are close, let's say, to potential output, that the economy is currently in 2022, according to the OECD, at full capacity. And that's because demand is very strong at the moment. And here I'm still saying at the moment, because if you compare, for instance, with the Great Recession in 2008, you had the recession. Well, it took about 10 years to go back to the potential output level. Well, since COVID, we are quickly reverting to potential level, and that has to do with the fact that households have saved a lot during the crisis. The government has put a lot of money in the economy. We have all saved that, and now we start consuming that. One big caveat, of course, that I have to mention, this is a situation, let's say, at the start of the invasion of Russia and Ukraine. The war, of course, could have a negative impact on economic activity. It could affect, and it does affect already, consumer confidence. This might lower aggregate demand, and this might lower these inflationary pressures from the domestic side a little bit. So that's a caveat here. But anyway, let's see what happens there. We still have to wait. But the initial condition, at least, is that the economy is doing quite good, or has been doing quite good. Now, what is then the second reason why inflation might last for a while? Well, secondly, I have observed recently that there has been, let's say, a shift in the fiscal policy regime. So we have a very strong recovery. I mean, that's because the fiscal support to households and firms during COVID-19 has been very successful. It has been very successful. It avoided the collapse of the economy, and that, of course, contributed to the strong recovery we have today. Now, what I observe typically is that now governments, they think that they can use that weapon, so to speak, or that approach, which is putting a lot of money in the economy, that they can use that to solve any problem, including rising energy prices and more generally losses in purchasing power of households. And they think, for instance, that because we have higher prices and people are let's say, want to be compensated for that, well, there's no problem. They say, we compensate you for that. Also because people expect that from governments. There's like a general fear of having more extremism and so on politically. So the governments just reply to that by supporting, by lowering VAT on energy, by giving people more money, and so on and so on. However, this does not work at the moment when your economy is at full capacity. And that's the big difference with the COVID-19 support. When the economy is at full capacity, any euro that you put in the economy, well, this just increases prices. This just increases inflation. And this has no effect on economic growth anymore. Therefore, we need to increase potential output. And even reductions in VAT in the short run, they might lower price a little bit. After a while, they will even be inflationary. They will even increase prices because in the end, it's a reduction of taxes. It's the government that puts and blows a lot of extra money in the economy. And I expect that this new policy regime will last for a while. Yeah, this will last for a while. Fiscal policy will be very expansionary, and that, of course, will translate into higher prices. Now, a third issue why inflation might last longer than we think and that we hope, that's the presence of so-called second-round effects. Yeah. And so even imported inflation, which is clearly there, rising oil prices, for instance, could become a domestic problem. Yeah. And then central banks have to react if there are second-round effects. And what are second-round effects? Well, these are, for example, wage price spirals. Yeah? So that means that when inflation increases, well, employees ask higher wages. In Belgium, it happens automatically because we have a system of automatic wage indexation. Well, therefore, wages increase, the cost of firm increase, they pass that on to prices again, so prices increase again, wages increase again, and so on. So you get these wage price spirals. And then, of course, the source is purely domestic, and then the central bank is the only way that can stop this, these spirals by increasing interest rates. Well, such spirals, it is typically the case for all shocks in the euro area, and as you can see, oil prices have increased a lot recently. And in order to illustrate you that, in this figure, I show results of my own research, where I show the effects of a 10% increase in global crude oil prices. So what happens here, what you see in these figures is that at period 0, there is an increase of the oil price by 10%. What happens over time, and these are quarters, 4 quarters, 8 quarters, 12 quarters, and so on, to consumer prices in the US and the euro area, and to all these different components. Well, as you can see in the United States, you see immediately a big and larger increase of CPI energy compared to the euro area. And you see that core inflation starts to rise a bit more sluggishly. Why? Well, that's because firms pass on the higher energy prices, energy costs into their prices. And you see up to 2 years later, you see increase of core inflation. But that's it. That's it. In the euro area, you see a less strong increase in CPI energy. However, if you look at core CPI, you see that there's a very persistent increase that keeps on rising and much more than in the US. Yeah, even 4 to 5 years after the oil price shock, you still see core inflation going up. Why? Well, it has to do with the wage price spirals, because here you see the reaction of nominal wages and also the GDP deflator reflecting that. In the US, nominal wages do not react to the shock, while in the euro area, you see wages following prices and you see the presence of these wage price spirals. And therefore, in the end, the ECB, in contrast to the Fed, has to react to these oil price shocks because of the second round effects that are present. So here, this illustrates that the current oil price shocks, they will very sluggishly probably increase in nominal wages and then higher interest rate. Now, then another thing, which is the elephant in the room, let's say, is international food commodity prices. And not only, we always talk about energy prices, but also food commodity price, and I start warning about that already more than 1 year ago, is that since COVID, also food commodity prices have increased by about 80%. And that's a lot. That has also increased a lot. And in recent research, I have investigated what are the effects, what is the pass-through of these international prices to euro area inflation. And in fact, it turns out, again, because of second round effects, that the impact of a 10% increase in international food commodity prices is actually more than double, ultimately on consumer prices compared to the oil price shock. Yeah, so this is a much more important shock. And we yet have to see a lot of these consequences. We are already seeing these consequences. Our food prices in the end are going up, but also wages go up again. And therefore you all again get wage price spirals here. And actually this impact is much stronger in Belgium. I guess there are many Belgians in the audience. And this means that, for instance, in Belgium, inflation even increases by half again, more than the euro area average because we have this strong link with automatic wage indexation. In the end, what I show in that paper is that there are large differences across euro area countries, and this, of course, complicates the single monetary policy stance because you require more aggressive monetary policy for those countries with high inflationary consequences of the food shock compared to others, and so on. Yeah. So let me just summarize here what I think will happen to inflation. Well, euro area inflation is now clearly a domestic problem. The higher inflation might last longer than expected due to this shift, especially in fiscal policy, which will probably last for a while. The second round effects that might last for several years. A disclaimer, of course, is unless the war in Ukraine depresses aggregate demand, and this could, if there will be a recession, if we go into a recession, that would stop these second round effects. And in fact, that's exactly what happens in the Great Recession. We somehow forget that in 2007, 2008, also energy prices, oil prices were moving up, shifting up a lot. Wages started to react to that everywhere, by the way, in Europe. So it's not only a Belgian phenomenon. But in the end, the Great Recession itself somehow lowered this, and therefore inflation vanished again. And that could happen again if we go into a recession. But if not, I expect that inflation will last for a while. So the conclusion, if you take it, even if you take into account this risk of a recession, the ECB should end its expansionary balance sheet policies, programs, let's quantitative, such as quantitative easing, and start increasing, in fact, gradually the interest rate. Should we affect a new regime of higher interest rates? Well, in the short run, probably the ECB has to raise interest rates, but I don't think in the long run that we are in a fundamental new regime, to answer Freddy his initial question in his presentation. We are fundamentally in a downward trend. Here, this is real interest rates taking into account inflation as well. There is this downward trend. This might reverse a little bit, but still do not expect interest rates to be much higher than inflation if we look a bit at more longer horizon, because these fundamental determinants of this decrease in interest rates, which is demographics, such as aging, this has to do with low productivity growth, this has to do with inequality. Some people have that high share of income and they only save it, and so they have excess saving, which reduces interest rate. There's lower investment demand of firms. The governments are investing less than in the past, and these fundamental determinants are projected to last. Except what could change that unless, okay, there is a substantial increase in government debt, and that might be because of fiscal policy changes, that we have to invest more in military expenditures, in climate change, and that governments now have this mind shift where they believe that they can solve any problem by spending more money. Well, then, of course, government debt might increase substantially, and if that's the case, then we might also see a change in the real interest rate, but yet still a lot has to happen before that will turn out to be the case. So thank you.
Thank you very much, Gert. You started relatively optimistically, but as time went on, it became a little bit less positive. I imagine there are a lot of questions and remarks in the audience. Don't hesitate to use the chat function to bring your questions to us, and after the last speaker, we will have some Q&A opportunities. Thank you very much. And now I'm giving the floor to Wim Boonstra, a Dutch economist, active in Rabobank, but also at the University of Amsterdam. And I'm pretty curious to see his advice and how he looks at the actual situation of the Eurozone. Please, Wim, the floor is yours. Wim, je micro.
Ja, maak u op. Wim, uw micro staat af.
Krijg
Je zet hem altijd af en aan, of aan en af.
Okay. Now you hear me? Do you hear me?
Yeah, perfect.
Okay. And you see my slides as well?
In PowerPoint mode, not in presentation mode.
Het zat in feite, ik had hem eraan staan en vervolgens kon ik niet een geluid bijschakelen.
You can select your window with the PowerPoint and then shift type F5. Select the window and then F5.
I have to stop presenting, I'm afraid.
You don't mean that.
And then I try to do it again. Agree?
Yeah.
Okay. Okay, do you hear and see me?
Yeah, but we can't see you.
You can't
The
see
camera
me?
is off. Camera is off.
Okay, that's not the most important thing. You can see my slides.
Yeah.
Okay, apologies for this this mishap. When you're presenting, you cannot change your microphone mode, I found out. Good afternoon, my name is Wim Boonstra. One small correction. I'm not working at the University of Amsterdam, but at Vrije Universiteit Amsterdam, which is something completely different in the world of Amsterdam. What I would like to do is discuss the challenges for the ECB. I fully agree with many things that Gert Peersman already said about the central bank having to start, monetary tightening. And of course, then we have the question, how can we deal with the situation where we are? And actually, I'm in an optimistic mode. I expect that the current situation may bring some rather unique opportunities to strengthen the Eurozone and solve a lot of problems. Now I have to go to my next slide. Okay, there it is. The situation is that the European Central Bank, or the Euro system to be more precise, has acquired an enormous portfolio of securities, including an enormous amount of public debt, which already has been issued by member states. And this has brought to the next situation that the liquidity, banking liquidity, has reached unprecedented proportions. And then, of course, the discussion is, should we go back to the original situation? How should we deal with this banking liquidity? And there are several options there that are available. It's important to realize that the public debt acquired by the Euro system, of course, is already mutualized. It's on the balance sheet of the central banks, and it's mutualized. Keep this in mind when I continue with my ideas I have in the remainder of my presentation. The challenge, of course, is how should we normalize the situation? And we should realize that the public sector purchasing program, of course, is monetary financing of public debt. It's not, of course, traditional monetary financing, which is not allowed under the European treaties, but it's ex post monetary financing. But in the end, if the ECB would have done direct monetary financing, the previous picture would be more or less similar to the situation we're in today. And then, of course, the question is, should the ECB demonetize this public debt? Which, of course, would mean reselling the portfolio back to the market, or should it keep it on its balance sheet forever? And other questions to be answered here. What are the consequences for the Stability and Growth Pact? And of course, does this challenge also bring further opportunities? And To answer the first thing, demonetizing is a bad option. Once public debt is acquired by the central bank, it has completely lost its monetary significance. Because in the end, the government is a shareholder of the central bank. As Paul de Grauwe had put it, it is a circular relationship between Minister of Finances doing payments to the central bank and receiving payments from the central bank. So it can keep your system on the balance sheet into eternity. This does not add to new inflationary pressures. So if the central bank would decide to demonetize, of course, it can do it. It can do it by replacing maturing debt. The problem is there that it will take decades, several business cycles to complete this process. Not really an option. If it would actively resell the portfolio to the market participants, it would probably bring a major turmoil in financial markets. And from an economic point of view, it does not make sense. So basically 2 options here, either rewrite the Stability and Growth Pact or redefine the relevant debt. If you see how much the ECB has already acquired, you see it's substantial. It has acquired of all Euro member states. And if you would correct on a national level the debt ratios of the countries, you see that the average debt ratio would decline. So basically, the option could be, let's keep it on the balance sheet and let's take corrected debt ratios in the end under the existing Stability and Growth Pact as leading here. Technically, this is not a problem because it could be scrapped, but then of course the ECB would have negative equity. And although the history is full of central banks that actually function with negative equity, even the Dutch central bank did it in the 1930s, it would be bad for the reputation. So my suggestion would be keep it on the balance sheet into eternity. No new inflation. It would help to prevent a too restrictive fiscal policy in Europe. But the real problem, of course, is here moral hazard, because it would be a male bailout. And if policymakers see it as this and expect that this will also be there into the future, fiscal discipline may be completely undermined by this action. So my idea would be, first, only countries that meet the deficit reduction targets under the SGP are rewarded by changing part of their debt into perpetual debt, which is not relevant anymore, but only as a reward for pursuing proper fiscal policies. And secondly, which is something we should have done long before, we should redesign the Eurozone in a way that market discipline could improve. So this is the next part of my presentation. The euro is a currency which is rather stagnant in international markets. This may surprise you, but when the euro was introduced, it had a market share in official reserves worldwide of about 20%. And in the meantime, the euro has increased from 11 to 19 member states, and the euro still has a market share of 20%. And if you have a closer look at the international position of the euro, then you see that it's used, of course, in the Eurozone. It is an important currency, number 2 in the world. But its international use outside the Eurozone is strongly limited to the countries in Europe, in our neighborhood, and Africa. And the euro is running the risk that it will be surpassed by the Chinese renminbi in the next decades. China is working on strengthening the international position of the renminbi, and it should be taken seriously because China usually is rather effective once it has a target. The Eurozone needs a well-developed capital market, and this requires something as a common safe asset. And the issuance of conditional Eurobonds would have brought safe assets. I think I was one of the first in the world that actively advised to do this. Be sure, conditional Eurobonds, not a free rider thing for the weaker economies. But this debate has become too politicized. There are many other ways to organize a common safe asset, but one of the most promising options here is that the central bank actually starts to issue securities. This may surprise you, as the central bank in Europe, the European Central Bank, has never done it. But if you look at global-wide, you see that many central banks in the world, about 30% of them, actually actively issue central bank securities. According to IMF writers, it's one of the most market-friendly approaches of open market policy. And serious central banks, including this of Sweden, Switzerland, Japan, Korea, already actively use this instrument. Switzerland, for example, is an excellent example. It has issued quite a large amount of money market papers, S&B bills, during the strong inflow during the euro crisis from euro money to Switzerland, which led to an enormous increase in liquidity, and they wanted to mop it up. And yes, well, they for billions and billions, dozens of billions, Swiss franc and securities, just to regulate liquidity. The Riksbank does it. That's made with short-term instruments. Some central banks issue actually central bank securities in order to establish a yield curve over the full length of maturities. For example, in Chile, the central bank even issues 20-year bonds, simply because the government is not, the market is not liquid enough to give a benchmark for the home market. And actually, there is no reason, no economic reason why central banks should limit itself to short-term issues. But of course, it is clear that it would be in the European context, maybe highly sensitive, making it a better idea that central banks start to issue with short-term paper. The central bank, in this case, issues papers to banks, but these are tradable on the secondary market. So immediately other investors, international investors, may enter the market as well to buy this stuff. They are not part of the monetary base. They do not count as banking liquidity, but of course they can be, well, changed into liquidity because, of course, it is a high quality liquid asset and this market may be very well developed. I have two slides here next, where in a highly stylized way, I show what the marketing, the balance sheet impact on the central bank could be. First is neutralization of existing liquidity, which basically is where the European Central Bank, the challenge it's facing today. And the second, of course, neutralization of new liquidity. And this is relevant to central banks that interfere in currency markets. And of course, so far, the ECB is not doing that in this extent, but it may happen if the euro suddenly would become a much more popular international currency, because finally there is something of a well-developed bond market. If the ECB would issue security, you see there's only a change of the liability of its balance sheet. So you see that the liabilities to credit institution, the bank reserves, decline, and the debt certificates issued by the ECB increase. So it's just substitution liability side. You don't have to resell anything back to the market here to reduce liquidity. If you have a strong inflow, then you see, of course, that on one hand, there's an inflow of money. Central bank interferes, which in the end means that its foreign exchange reserves increase, which may be mirrored by higher liquidity in the market, but with issuing debt certificates, you can neutralize this. And of course, in the real world, most markets will have combination of these two stylized scenarios. So come to the conclusion. The current situation, of course, is problematic, is rather unique, but it offers several serious opportunities. It gives the opportunity to start with a lower public debt level than we thought so far, preventing a too restrictive fiscal policy. But of course, the real caveat here is moral hazard, and the confidence between member states, of course, is not very well developed, I would say. So this should be a strong disciplinary factor there. Draining of liquidity can be done by securities by the ECB, and this is nothing strange. Many central banks, major central banks already do this. And I think that the only thing why the ECB so far has not doing this is that they fear for the political setback about, well, we don't want to have mutualized debt. But we should realize that this debt is already mutualized by the central bank. The only way change would bring that it would become tradable again instead of being fixed on the balance sheet of the central bank. This could give the Eurozone a large and very liquid market of common safe assets, which in the end may be comparable what's going on in the US, also making it very difficult for the Eurozone to fall apart. And if you have a strong foundation of commonly issued debt, then you can also expect that market discipline to member states, and especially member states that fail to pursue good fiscal policies, in the end will do a much better job than it has so far. Could be an important pillar under the capital market union and strengthen international position of the euro. So I would say I'm not too pessimistic. I think that today's situation, if we make the right decisions here, we make as a Europe, as a monetary union, come stronger out of the situation than we actually were a couple of years ago. Thank you very much.
Thank you, Wim. Thank you also for that optimism, interesting ideas, even if politically, I imagine, it will require a lot of debate and discussion at all levels. Thank you. And now we have our third speaker, Bruno Coleman, well known, has a very broad, diverse career in banking, finance, consultancy, and also as a professor at the ULB. And I'm sure that Bruno has also a number of very specific thoughts about what the actual situation means for the future and what could or should be done or perhaps not be done. Bruno, the floor is yours.
Thank you, Freddy. I'm pleased to be with you today, and I will try to adopt a more, I would say, intuitive approach, far from the grounds of academics, and to share with you my expectation of the outcome of all this with a kind of a socio-political because the point, and I totally agree with my two colleagues, what has happened since a couple of years is that the central banks have kind of lost their independence, and that the intimacy between governments and central banks has given birth to a new environment that is far away from what we used to call the market economy. So there is some kind of nationalization of the economy today, and let me share some slides about all this. So I'm not that good with my slides. So can you see my slides?
Yes.
Okay. So the first point is that we all know that money is a public good, but mainly created by private institutions. It's a stock and a flow. We know that's a whole debate between the banking and the currency school. And what we have observed since some years back is that the stock of money has increased, but that the velocity of the so-called private money has decreased. And that explains to some extent maybe why the increase of money supply has not immediately given birth to inflation beyond what we all know, unemployment and the use of production capacities. The decrease of the money velocity is striking. It started long ago, but especially after the crisis of 2008, and that's a new given in the economy. The second point, and I've written some books on that, is that the euro has fundamentally changed since the crisis of 2008. To me, on political grounds, the euro was a pure neoliberal choice because it was based on the mobility of capital and labor. Of course, we know that labor in Europe is not as mobile as it is in the US. And one of the examples of this political choice is that the euro was defined by its own inflation rate. So it was there to protect capital, asking labor to adjust to the concept of money. Of course, things have changed since the sovereign crisis and the COVID crisis, and the euro philosophy has changed. from the protection of lenders, of savers, sorry, towards the promotion of labor or the promotion of the global economy. And what we see today, and it was well explained by our first speaker, is that the ECB has failed because the assumption that the ECB would fight any inflation above 2% was made on the assumption that we were living in a kind of closed economy and that there would be no imported inflation. So what we see today is that the ECB is stuck between its own mandate and the realities that we are facing with food and energy prices that have significantly increased since 2 years ago. So we see that basically the way the euro has been designed is flawed compared to the present circumstances. And that's a very important fact, and it explains why, by the way, why it's explained to me, according to my intuition, why the ECB is always downplaying inflation expectation. It's striking to see that when inflation was reaching 5 to 6%, there was one kind of a chief economist at the ECB claiming that the inflation rate would be down to 2 or 3%. So that didn't make any sense, but it was an argument needed, of course, for the ECB to explain that it would not increase interest rates. To me, inflation, contrary to what has been said, is here to last because the disinflation in our economies, and we all know that, started 40 years ago when Volcker in '79 decided to fight the US inflation. But the disinflation has been fueled and helped by the globalization. And we can observe today that globalization is not as strong as we thought. And then it would become more expensive. So it means that if globalization becomes more expensive, there will be an inflationary trend somewhere in the economy, in addition to what we see today, since the food and the energy shortages have been stated. In addition to that, the climate transition will have to be financed. This will cost a lot of money, and this will, of course, lead to subsequent disruption in the supply chain. So to me, inflation is there to last, but it will not be an inflation that will be fueled by the increased money supply. Because the increased money supply is compensated by a decrease of the money velocity. So we are facing external factors mainly that will explain why inflation is there to last. And of course, I will skip the following slide. We all know this slide where inflation has increased significantly. But that's not the point. The role of central banks has changed. Actually, the central bank gave, again, according to me, since 98, sorry, put to the market that was the LTCM collapse. Today, central banks control the full yield curve. When I was at university, I was taught that central banks would control interest rates until a maturity date of 1 day to 1 month, sometimes 1 year. Today, we see that the whole yield curve is being controlled by central banks, which means that the central banks have become market infrastructures. Government and the central banks have exchanged their assets and liabilities. The liability of government has become the asset of central banks, and the liability of central banks, that is money, has been given to government. So it means that if we would consolidate the governments and central banks, on the liability side, we would have money, and on the asset side, we would have the hope of future growth that can be, of course, diverted into some taxes. The point also, and it's more an intuitive approach than an academic fact, is that since 2 or 3 years ago, the ECB is refinancing the welfare state. Because one cannot distinguish the action of central banks from the reality that we have promised huge social expenses, and I'm thinking, of course, pensions, that will have to be financed by public debt. We all know that if we would discount today the value of future pension commitment, if we take Belgium, we would have something around 4 to 5 times the GDP, which is almost impossible to finance through contributions and taxes. So that public debt will be there to compensate. And again, that will, of course, fuel some inflation. And that leads me to the idea that the concept of money, even more than today, will be nationalized. A little bit like the Chicago plan of Fisher, who was designed almost a century ago, and that the central banks will be pushed by governments to keep on refinancing public debt, notwithstanding the fact that central banks will have to play other roles regarding to CBDC and cryptos, but this is a totally different story. My key point is that central banks are there to last in the help they do provide to governments. And of course, we see that in the proportion of public debt that has been refinanced by central banks in Europe on the left-hand side and in the US on the right-hand side. And you can see that on the next slide. But the real question is to know what is the ending point of all this. If we make the assumption that social expenses will have to be financed by public debt, and that public debt will have to be refinanced by central banks, that is, by somebody who did not exist and avoids the crowding out effect, what is the ending point of all this? I think that beyond everything, money is a ratio between production factors, and I'm talking labor and capital, which means that in order to buy social peace, and in order to avoid social inequities, government will have to print more debt than today. So public debt will continue to increase, and it will be the price of social peace. Of course, it could happen at some point in time, and especially in the Eurozone, that the central bank would decide not to refinance this debt or to put brakes, on its ability to increase money supply. Then the question will be to know who will finance these public debts. Of course, in the first stage, governments may ask their domestic banks to carry public debt. It has happened in the past and it will happen in the future. There will be, of course, a little bit of inflation to decrease the real cost of this debt, a little bit of taxation of capital, maybe some political pushback of neoliberalism. But to me, eventually, the banks will be nationalized or close to being nationalized because they will be forced, if the central bank is not able anymore to refinance government, they will be forced to refinance government. And the purpose of all this is to avoid social disruption, which means that our savings will yield almost nothing, not putting away the idea that one day government can ask directly to the taxpayers or to the population to finance public debt, like it happened in the 80s. So it could lead to tacit nationalization of private banks. And this is my landing point. I think that at some point in time, in order to avoid social unrest, to avoid social turmoil, social disruption, capital will have to be channeled directly or indirectly through the balance sheet of banks towards the financing of governments if the central banks doesn't increase its money supply anymore or decrease the pace of creating money. But even if the central bank would decide to keep on discounting or buying public debt, there would be inflation that would be another way to hit public savings. So one way or another, I think that savers will have to pay for this sequence of crises, and that the savers or the capitalists are less rich than they think they are because of all this. And this is my intuitive conclusion. And I took a quote from Shakespeare, in King John, to summarize maybe my pessimistic view of all this, is that so far the sky clears not without a storm, and I think at some point in time the storm will happen. Thank you.
Thank you very much, Bruno, for this not so optimistic story. but it's food for thought. Now, thank you all speakers to stick to your limited time. You could have given a presentation with this content that would last an hour. You have done it in 20 minutes. That's fine. It's sometimes frustrating, but that means that now we have some time to discuss and to see if there are questions from the audience. Perhaps, first of all, is Wim or Gert there to react to what we heard from Bruno? Any immediate reaction? If you raise your hand, then the Secretariat... Well,
I have to apologize. You know, I'm teaching at university like you, but I took a non-academic perspective, so I would apologize for that.
Yeah, no, it's... okay, first Gert and then Wim.
Yeah, no, thank you. I mean, very interesting. I have actually comments about both presentation about Bruno. Now, on the one hand, I think I mean I agree that to some extent there has been some changes related to the policy of the ECB, and then I'm thinking in terms of the maybe the put option a bit. The fact that financial stability has become more important more recently compared to the early years of the euro, that's for sure. I mean, the instruments have also changed over time, but we still have to see the fact about the choice of inflation, what you call savers, protecting savers versus stimulating economic growth. We still have to see that choice, because in the end, if we look since the start of the euro, most of the time inflation was too low. Yeah, so it was too low. It was clearly below the target, and the ECB did everything in order to increase inflation again by using quantitative easing and a lot of new instruments. And yet, now what we see the inflation today, I think we cannot blame the ECB for that. This is not a consequence of years of low interest rates. I mean, and even the fact that if you take into account the lags of monetary transmission, then if the ECB wanted to avoid the inflation of today, or central banks more generally, they had to increase interest rates during COVID. They had to do that 1-2 years ago, which was in the middle of COVID. I don't think that anyone those days thought it was a good idea to increase interest rate, potentially to have lower inflation today. So you cannot really blame the ECB for that. Yet, we still have to see now what will happen in the near future related to these choices, because now inflation is clearly above the target. Now clearly COVID is over, and now the ECB has to make choices whether they indeed will fight inflation again, or whether they will keep on stimulating the economy. So yet we still have to see whether there's a fundamental change there. And I actually, in fact, I think that they will increase interest rates. It's like what the Fed is doing now in the US. And I think in the end, they will keep on raising interest rates, despite the fact that this might hurt governments. So, yeah, I haven't seen the shift.
Yeah, thank you. I totally agree with you, and thank you for your observations. You know, I think that the ECB is really stuck, because if they raise, of course, the ECB may raise interest rates, but as I thought I understood from your presentation, they will have trouble fighting inflation, because as you mentioned, it's imported inflation. In addition to that, if the ECB starts to increase expectations of future rate increase, this may maybe hurt some countries, and to some extent, maybe, I don't know, disrupt the homogeneity that has been found back in the management of the euro. So I take your point. Another scenario could be that the ECB lies with itself, downplays inflation expectations, and let inflation bite on the value of public debt that has been issued by governments. I don't know.
Wim, do you have also some comments to share?
Well, very briefly, because Gert already said a lot of things, but I agree with. I would have asked the same questions. One more question. I have the feeling that one of the problems is that the ECB has become too politicized. It was unavoidable, I think, because in the Euro crisis, European politics was simply too slow to react or even to prevent what went wrong there. And if the ECB wouldn't have stepped in, the whole thing would have fallen apart, I'm afraid. But now it should be able to retain more distance from political, and that requires a fundamental reform of the Eurozone and strengthening. And you said that I was an optimist, but I share Bruno's pessimism that there could also be a big storm, and the ultimate big storm, of course, would be that in the end the whole thing falls apart, and then we have a crisis that we have never seen before. And I really hope, and I hope to share my hope, that this will not happen. Your microphone is off, Bruno.
Sorry, my mistake. No, thank you. It reminds me of something, a small event that took place in 2008 or 2009. At the time, during the big crisis, I was the CEO of the stock market in Belgium. And I had regular meetings with Trichet. And then if you do remember, in 2011, twice he increased interest rates. We were at the start of deflation, and then he started to increase interest rates. And then Draghi stepped in and decided to reverse the rate increase. And after that, I asked Jean-Claude Trichet, why did you do that? Because it was so obvious that increasing rate in these times was not the right decision. And he told me that he had been forced by Germans to do that. So it means that already in 2008, 2009, the ECB became politicized. But today, it's so politicized that there will be, to me, no way to debundle the ECB from the influence of governments. There will be no way. Since when the central bank carries, I don't know, 30% of the Eurozone public debt, and we all know that these public debts will be refinanced, so it's a little bit as if they would be neutralized forever in the balance sheet of the ECB, it means that they have created a link between governments that cannot be bifurcated. So, something around these lines. You know, if you are the government and the central bank and I owe 30% of your debts, we get close to each other, we become partners.
Okay, there are quite some questions, but we have only limited time left. One of the questions from the audience pointed to the fact that the Federal Reserve clearly is committed to reduce the balance sheet. Now, do you see it practically possible that the ECB has a totally different view, and what could then be when you said if we keep the balance sheet and that it could be an opportunity to create liquid assets which would increase the confidence in the euro? On the other hand, if the Federal Reserve is reducing its balance sheet to go back to the old normal, while the ECB is sitting there on an iceberg of debt, where accounting-wise you can say it's not debt anymore, it's frozen, will that not have an impact on the relation dollar-euro from an international point of view? So,
well, there are a lot of questions here. Very briefly, I think the exchange rate is for a huge economy like the Eurozone or the US not that important. I've seen the euro being introduced, being fallen to $80 cents. It was 1.6 after the crisis for a brief period, then it comes down. That's what currencies do of major economies. And I don't think that's a real serious problem here. There's a major difference. The Fed operates in a huge liquid dollar market. So if they resell debt to the market because they want to have a smaller balance sheet, it will not immediately lead to big interest rate differentials between California and Texas or whatever. They operate in federal debt. The ECB doesn't. So the moment they resell to the market, you will immediately see that the tensions we had in 2010 in the Eurozone increasingly will be there. And which basically is one of my arguments to have to organize a big money market, which is commonly guaranteed, because then you can have huge monetary operation, buying and selling of stuff. And what individual countries do depends on individual fiscal policies. And if countries fail, there's the Paris Club, there's the London Club, but the ECB is not going to bail you out a second time. That should be the credible threat. Is that not there? Then the ECB cannot do my proposal, but then we will have a long period of below par economic growth in the Eurozone. And well, it will be the last 10 years all over again. So you told me an optimist. I am, but if they take the wrong decisions, I think the dangers are really, really serious.
Okay. Yes, Gert.
Yeah, I would like to add something to that, and from that point of view, I do not agree with his point about the fact that debt is neutralized on the ECB balance sheet or frozen. In fact, it's not, even if it's on the balance sheet. So what the ECB, in the end, it's important to know that the owner of the ECB is the government. Yeah, so somehow you have to consolidate them, and all profits and losses from the ECB, so to speak, profits today, these are quite a lot, go to the government. Now, what does the ECB do? They buy the government debt, which means that the government pays interest rates to itself. However, they buy it using bank reserves. Yeah, so what the ECB does, and that's why the money stock is in itself not crucial, the ECB is just swapping government debt into bank reserves. Of course, the ECB has to pay interest rate on bank reserves. Today, that interest rate is negative, but that's also the case for government debt. These interest rates are negative. But now when ECB will start to tighten, the ECB has to increase that interest rate. It's the only way. The deposit rate has to go up. It's the only way to increase the market rate, because it's determining the market rate. So what's happening there is that if the government is actually paying interest on the debt via bank reserves. And in the end, what ECB has done is like a maturity shift. So they have shifted longer-run debts at low interest rate, which is quite risky, into very short-term securities, which are bank reserves. So if the ECB starts raising interest rates, they quickly will have to pay a lot of interest rate on that whole balance sheet. And for instance, if the ECB would get rid of the government debt, they also would not have to pay the short-term interest rate on the bank reserve. So it's again, it doesn't really matter a lot. It's like a maturity transformation. So in itself, it doesn't really matter whether you have a lot of money or not. It's just a maturity transformation. What matters for the economy is the interest rate and so on. But here, from the government point of view, fiscal point of view, it's only a shift in the interest rate. So you never can get rid of it. Even if the ECB says you never have to pay it back, well, the ECB will then forever have to pay interest rates on bank reserves.
Well, I think I do not agree. The issuance of central banks bills is in 30% of world central banks is happening. They use it to create more liquidity in the market or to take liquidity out of the market. And I've never read in the newspaper that the Swiss National Bank or the Riksbank or the Bank of Japan actually had problems with their profitability. And even if they had, a central bank is not a profit-making institution, it's a public institution with a public function. And my point is that if it's owned by the central bank, we have indeed, as you explained, the situation that the Minister of Finance pays money to the central bank and the central bank pays it back to the government. So it is a closed loop. As Paul de Grauwe also explained in his paper, which I had in the literature. And of course, it doesn't make sense to burden society with reduction of government spending or higher taxes in order to repay debt which is already owned by the government. And that's
but that's, I mean, I think I get the point that there's a difficulty for government to start, to pay that debt, but they can also extend their debt and borrow again forever. And then it ends up being the same. You can issue debt again. So it's the same problem. And it's like not fully closed. It's not just the government pays to the central bank and the central bank back to the government. The central bank also pays to the bank. And so there's a net interest payment that comes from government and central bank together, which is unavoidable if you increase interest rates. You have to pay interest on bank reserves.
Okay.
Yes, that's not something really new. And actually said that the political thing, what Freddy mentioned, this debt is already mutualized. And if the central bank and monetary financing, okay, exposed, so it's an open market operation, albeit a little bit large. Well, if you can debt sell to politicians, you could also issue central bank bonds and sell that as an open market operation to politicians. And in this example, it would be the right explanation as well. So it's I remain optimistic because I believe in the future of the euro, and I hope I'm right.
Okay, if I may try to conclude, no conclusion, because it's very interesting to hear economists who are not fully agreeing. I think we had a very interesting overview in this webinar. No final solutions or agreement. It would have been too ambitious and impossible. I think this issue, as also Bruno and the other speakers clearly said, is not only a question of some central bankers who do things. It's also an issue about society, about the financial system, about the nature of money, because it's all interlinked, and I don't think that the topic will disappear from the agendas in the next few years. So to be followed up. May I thank all the speakers for their excellent presentation and discussion, and also the audience for their patience and their questions. And it's a good thing probably to see if we cannot have another session around this same topic a little bit later, perhaps when the clouds of the Ukrainian war are over and we can already think about a more peaceful future also for central banks. Thank you all, and hope to see you soon again.
Thank you. Thank you.
You're welcome.